So you, Julian, say going all the way back to 2017, you favored tech and thought it was going to do great, and now you are actually finished. Not totally finished, but you think there's a sea change. The stocks already reflect a lot of the good news. It's going to be tough to move no matter what the earnings are right now, and you would sell strength or actually lighten positions in tech, big tech.
So the clincher is what you've been talking about the first 15 minutes of the show. We're likely to get higher taxes either this year or next year. And when you think about it, particularly if it's a capital gains tax, the majority of the capital gains over the last 3 to 4 years have come from these large cap tech stocks. They're not sells on a secular basis, but when we look at the first tax bill coming due on May 17th, and we look at the fact that, last night, for instance, the EV maker reported great earnings, great numbers, and the stock did not respond has not responded well. It just tells you that these names, secular growers, are likely to take a breather.
Really, for the intermediate term, for how long? How long would you stay at? If you got a pullback, would you go back in, Julian? Or this is a pretty big call you're making for the foreseeable future?
Well, when we think about the path to higher stock prices over the next 12 months, to us, it's clearly going to be led by the value stocks, financials, energy, perhaps even a beaten down sector like consumer staples. But the long-term story for secular double-digit growers is going to be higher prices. So at some point, look at it, most of these stocks have gone sideways for the last 6 or 7 months. We think on weakness, they will be a buy at some point.
All right. So, Greg, I think you're more selective. You think there's some tech names you'd like to own, but I was referencing you and others earlier in that you definitely have you've got one eye, maybe more than one, on inflation and inflationary expectations actually finally coming home to roost. True?
That's right. I think there's an earlier boogeyman than taxes for this sector, and that is whether or not inflation spikes past that mid-2 range that the Fed said it's comfortable with. If we see that, or if we see persistency that is longer than the couple of months they're expecting, the market will anticipate that the Fed will have to change its posture. And rising rates, prompted by speculation on Fed posture change or action earlier than expected, is more harmful for tech and growth. It actually has a positive correlation for cyclicals and value. And so I think that would be the area of more concern I have in terms of a breather. But I do agree with Julian. There is a strong secular story for select names here. And I think this quarter and next will help us ferret out which of what we've seen over the last 12 months has been cyclical and what has been secular.
Greg, the bond market is so big, and the 10-year's still at under 1.6. So is that not a disconnect from the kind of prognosis you just gave for inflation? Is something amiss? Something doesn't seem right? Something's rotten in Denmark?
I don't think so. I'm not that skeptical about it. I think what needs to happen is, look, we all expect there to be some inflationary pressure. Our supply chains are not intact. Demand is going to rush back as we reopen the economies in a global synchronized way. The question is, how quickly can we restore them? And so the Fed is fully expecting at least 2.2, 2.3% inflation. The question again will be, does it rise above that? And so I don't think we're seeing anything nefarious going on. We're taking a wait and see approach right now because no one.
So you're a transitory guy. You buy into that. You do.
Some things we got to wait. Some things we got to wait and see, my friend.
Shepard Smith here. Thanks for watching CNBC on YouTube.